My name is Sateesh Balani. I am a director with CFA Society Pakistan as well as director research at Iqbal Securities. Hope you all are also fine and I'm audible to everyone. Orena, have we enabled chat for them?
Yeah, the chat is enabled for everybody.
So if one of you can just okay, so I'm audible. That's it. That's fine. Some of the housekeeping rules of the session. We'll have 1 hour session up to 5:30, and it'll have a Q&A session as well. All participants are requested to keep their videos turned off for the session, and we'll request you all to turn it back on at the end of the session for a group photograph. All participants are requested to stay muted throughout the session. We'll have a Q&A session at the end of the after we are done with the presentation, the initial small presentation I have, which is roughly 20 minutes, 30 minutes roughly, it will take for us to complete this. And you guys can submit your questions through chat box. And we'll have this session recorded for all of you so that you guys can go back and revisit how financial modeling is done. So what I'll just briefly tell you guys. So in this session, you should not expect that I'll be helping you make a model. I'll tell you what financial modeling is and give you guidelines on how a financial model is, what's the purpose, what are the steps that are involved in the process of making a model. And I assume you guys have attended equity valuation session which was held yesterday, day before yesterday. So if you guys have attended that session, then this session would help you how to build onto that. So you learned how to value a business, how to do equity valuation. Now you'll add on to it in this session how to take it to a financial model stage. Moving on, what is a financial model? The first question, which is I think everyone should be knowing, it's basically a tool. It's not the we don't do any magic when you are making a model. It's just an Excel file in which you try to assess a valuation of different companies. Or it's also, the financial model is not only just to determine valuation, it's also used to calculate IRR of different projects, what is the return that you are seeing, net present value of different projects. So this is how. So it's a tool, just like calculator. When in school you must be doing any session, any exam, you use calculator. So calculator is a tool in which you are doing summations and subtraction, or even calculating now present values through calculator. So it's just a tool which you build for your own help as an investment manager, or as an investment analyst, for to assess valuation of any company. So what should a model have? So a good financial model should be, it should be simple, should not be complex that even a person, because a model, an analyst makes a model. You must have learned what an analyst job is. So an analyst makes a model, he assesses a value, but it is, the model is used by other stakeholders as well. Different portfolio managers are assessing models. When you are doing a capital markets transaction as an investment banker, you make a model. When it goes to clients, they also access your model, and they also try to understand the model that you have built. So it has to be simple so that anyone who wants to understand valuation of the business should be able to understand the model first. Obviously, you need to have a focus on key profitability drivers. For example, if I am in a business of brokerage, so I need to see what are the main profitability drivers for brokerage. Since it's a service business, so I have manpower cost is the major cost. My revenue is driven by volumes or the stock exchange trading, which happens at stock exchange. My so volume, and the pricing also. So pricing on what revenue do I make on every trade that happens at stock exchange. So in a brokerage, so this is the revenue drivers. Accordingly, you also analyze what are the cost drivers. So manpower is a cost driver in a service industry. That should be a hint to the company that you are working on. So you should know what are the key profitability factors of that business which you are doing valuation for, or you are doing assessment of. Even if you are making a project, or if you're calculating a returns of a project, you need to know that that project returns will be after that project commissions, and how those profitability drivers move. So you need to end of the day, we whenever you are doing forecasting, whenever you are making forecast for next 5 years, 10 years, 20 years even, so you need to convey your assumptions very clearly. If I assume any assumption that I take, even if the be it macro assumption or micro assumption, it impacts on the valuation of the business. So if I assume that inflation will be 10% over the next 5 years, that impacts my interest rate assumption also. So accordingly, but whenever you are making a model, your model should have a one sheet explanation of not one sheet explanation, but it should contain all the assumptions and conclusions on one sheet, which is able to, so that you are able to understand, anyone who is reading the model is able to understand what is the basic assumption of that model. And obviously through that model one should be able to assess what are the risks associated with the business. So sensitivity analysis in terms of break even, in terms of factors impact your profitability, what factors impact your valuation. So that is very important. So charting out scenarios, if I want to see, if for example I'm valuing a technology business, and if I have to see that if that business grows by 20% every year, what should be the valuation, and if it grows by 15%, what should be the value of the business. So that type of sensitivity analysis or scenario analysis has to be there. So often you also make basic version as well as so optimistic version. What is the optimistic scenario for the business, what is the pessimistic scenario, and what is your base case. So that's how you try to calculate that as well. Then obviously there are other ways also to check overall return on your model. You can you can compare. EV is basically enterprise value relative to cost of new assets. For example, if I'm evaluating a cement plant, so I need to see what is the cost of putting up a new plant today. If that cement plant, if I'm getting cement plant from the stock market directly at $50 a ton, and if set the cost of setting up a new plant is $60 a ton, so that means this is just a ballpark method of assessing whether my valuation is close or not. So this is how you also do valuation. And obviously you need to be sure of what are the assumptions and what is the, someone is, okay, so you guys can keep adding questions on the chat, but we'll answer them towards the end of the session. So you need to set a number of assumptions and translate into financial ratios, cash flows. How do I interpret this? Any kind of change in your assumptions will have an impact on the financial ratios. For example, if cement, for a banking company, if interest rate pricing determines my profitability, so interest rates go up, my net interest margin goes up or my profitability goes up. So that is one of the financial ratios used for banks. So that will, so you need to have that set of assumptions. What is your deposit growth that you've assumed, and how do financial ratios change with the deposit growth you assume, with the interest rate assumption you take? How does that change your overall valuation? That should be in a model. So moving forward, these are few of the steps that are required to make a model. Firstly and the foremost, you need to have historical income statement and balance sheet, which uh, through which you know that how past has been, and based on what macro factors, based on what pricing your company's historical financials are. So first thing and the foremost thing is you analyze what historic financials have been and how operations of the company have been impacting historic financials, be it 5 years or 10 years, whatever your mentors suggest, you go for that. Then you input a base year data and calculations, assumptions into calculation section of the sheet. So there is so you have a sheet where you input all the base year data which has historic, and then you can calculate all the forecast. So you should have a separate calculation sheet where one can see what are the detailed calculations they're doing, and on the main dashboard or on the main financial model, on the main sheet, which is the view only sheet, you should not have all the calculations there. One of the thing which is one of the don'ts here I would like to highlight is you don't need to hard punch numbers in a cell. So if I have to if I'm making a forecast, I need to link cells rather than. So even if I know a number is, for example, if you know that terminal growth rate has to be 10%, but you don't multiply that 10% directly, don't type that 10%. Rather than that, put it as an assumption and then link your workings accordingly. I'll give you a small example towards the end of the session on how do you not type numbers and where do you type numbers. Then you compute ratios for historical data so that you can forecast it well, so you can see what trend has been. So tax rate, assets over revenues, payout ratio, these are for these things you will understand how company will look in future and how its recent past has been. So you can basically build a story or what exactly is going to happen, so you can analyze that. Then you can reconcile your different items available in the financials, so your movement in investments, capex, and other minority interest changes. Okay, so what is it that target data set you need? I just overread there was a question on how to build assumptions, how to make assumptions. So you don't make assumptions; they are general assumptions that you need to understand the business and accordingly position your model accordingly. So what are the value drivers for the business for revenues? So you need to understand like what should be the price and quantity. In a bank, for example, banking is a different kind of a business, but the revenue stream is effectively the same. The banks generally do financial intermediation. So you have a price, you have a quantity. So what is the price? Price is generally the interest that you pay to get deposits. Quantity is generally volumes in banking are deposits. So we need to analyze that part, that how price and quantity will move going forward. You need to assume that what is the price growth company will be getting, what is the quantity, how will the quantity, since for example if it's a mature industry your quantity won't grow much but your pricing can based on the pricing premium of the industry. Or if it's at the growth stage, so you'll have ample amount of quantity growth, or you can assume a double digit volumetric growth for the business. Operating expenses, you need to understand what are the fixed expenses, what are the variable expenses. In any business there are multiple expenses. I'm sure you guys must have studied cost accounting, so it's a basic. But whenever as an analyst you are analyzing, you need to analyze that if volumes increase substantially, what are the costs which will remain static or not increase proportionally, and what are the costs which increase with the which are variable costs. So you need to capture that in your model accordingly. So if my volumes are increasing, my variable cost should increase accordingly. So for example, for a bank, your branches which are already there, they would those expenses, the fixed expenses would remain even if revenues fall. But there are variable expenses also, so like manpower that you add. So every person you add in your business should be would impact your variable expenses. So this is how you have to model whenever you are building a financial model. Then there are variable value drivers for capex also. You need to understand what is the cost per unit of capacity. For example, if a company is announced that they'll be adding a capacity, or a bank is saying that we'll add 50 branches per annum, you need to understand what was the cost of adding branches last year. So you can extrapolate that. Okay, so if they added 50 branches last year at a cost of, let's say, 500 million rupees, so 10 million rupees per branch was the cost. So you need to model that. So if the bank is telling you we'll add 50 branches next year also, so you add that accordingly. So you model in your portfolio, in your financial model, you should have a number like cost per branch is 10 million, and number of branches that you plan to add for next year is 50. So then your expense or capex for that year will be 50 multiplied by 10 for that year. So, and obviously when you are doing financial modeling, you need to understand what the story is all about. So Mizan Bank, if they have uh, for example any of the bank, let's assume we're talking about Bank Alavi, they have 750 branches. If they're adding branches next year, so they can't add 200 branches in a year. They can't add 700 branches in a year, they'll add 200 branches maybe over next 2 years. So you need to, but you need to talk to management also to assess what is the amount of capex that is happening. So I hope it's getting clearer as we move, and it will be more clear. So you need to see that whether value drivers are making sense or not. So if a company has a market share of, let's say, 5%, and you are forecasting based on market share, you can't assume next year they'll have 7% market share in a year. And if they have, assuming they've had this 5% market share, they got this market share in 10 years, they can't have 15% or 7% market share in next 2 years. So it will take time. Or you need to have a strong basis. You need to evaluate economics of how those ratios or how those value drivers will behave compared to history. For example, if I'm into a business of cement manufacturing, and if I have been adding capacities, I've been adding efficient equipments to my plant, so my cost of production will be lowest. So you need to match this, that amount of capacity or capital expenditure incurred over last year will benefit this year. So you need to have that economics in mind. You can't just build the story out of it. So you need to have that value drivers, and obviously you need to see sensitivity analysis on value drivers as well. For example, if a company is too price sensitive, uh, the your price change will have an impact on the valuation. So you need to have that, those kind of sensitivity analysis also. In the previous slide I was just saying that model should have a sensitivity, but sensitivity of what variables you have to do, this is where you know that value drivers are the most important thing in the model. Key inputs in the assumption in your input sheet, you may have one sheet model also, in which you need to cover these inputs for sure. So you need to have revenues, you need to have operating expenses, working capital, depreciation, interest rate, what are your expectations, what are the future debt issues companies planning, future equity issues, dividend payout ratio, income tax. So these are the basic assumptions that you need to have in a financial model. This is a basic sample dashboard that I have just shown for, since you guys have to work on a banking model. So I think this is very important to analyze that this is how you have a structure. So I have my key drivers on the top left, where I can see what is the growth in deposit, what is the ADR. These are limited assumptions, just for your consumption of, just for understanding of how things work, or how, what is the eventual output that you have to achieve. So these are the key drivers. So in a bank, growth in deposits is one of the factors. What is the target loan to deposit ratio that you have to have? What is the loan losses? So if I'm in a bank, I'm lending, how much of my lending will go bad, how much of people will not give me money, give my money back, what is the risk free rate as I'm assuming, what is the yield spread that I'm assuming, how will the overall capital structure move, how will the dividend payout ratio remains, what is current price to book of the bank, and what is the cost of equity. So accordingly, you, this is a sample of dividend discount model valuation, where I've done is, what I've done is I've put in all the dividends, you calculate book value, you assign a price to book to that terminal year, and then discount it back and calculate evaluation standing today. So this is how a sample dashboard looks like. You might not, this is just the end product that we have, but obviously it can, it will vary based on the guidance you get from your mentors, and based on how you want to value. There are multiple valuation methods you guys must be aware of when you are valuing a bank or any of the business. So different multiple valuations are used for different companies and banks. So you need to assess that valuation and accordingly work on it. So these are some of the shortcuts I thought you guys must know. It's very important that during this course of this period, this IRC, it's a very good learning experience that you guys are having. So you can use these shortcuts to be more keyboard savvy rather than using mouse. It's always recommended that a financial modeling person or an analyst is savvy on keyboard and uses and avoids mouse as much as possible, because obviously as you are learning, your mouse will remain, mouse usage will remain there, but obviously you can minimize it as you learn and practice these shortcuts. It's also all practice, just like maths. You do control page up, page down, you can move around sheets with sheets. I use this the most, control and shift and control with space bar. You can select a row in one go, you can select a column in one go, you can select different cells, the shift 8. So these are all the basic shortcuts which you can which will help you. Control minus, control plus, these are also very used. These are one of some of the other shortcuts that you can use. So these were how you select data, how you navigate through data, how you move within the sheets. So these are those kind of shortcuts which you use most often. I would highly recommend to you guys to practice these shortcuts. Then you have data manipulation. You can how you can copy paste, you can enter formulas, you can get out of you can move around, and you can audit. So this audit part is most important for you to check your models. For so control curly brackets is the most used, and then F5 and enter, you can go back to your previous cell. So these are the two main shortcuts to trace how where your cells are linked to and where is the result coming from. So for example, if you tell me that you give me a financial model and there's a valuation tab, I'll use control open curly bracket to arrive at the formula through which that cell is linked, or from the cell from which then the valuation is coming off. So this is how it's very important. Formatting, I think alt ohr to change sheet name. You can use format cells. Alt es is one of the ways to paste special, which is most often used when you are copy pasting data from different sheets in different formats. Editing part, I think F2 is the most is also one of the most used shortcuts. So I whenever I'm auditing or even reviewing any model, F2 is the way to learn. If you have any sheets which you are accessing, if you have any sample Excel models that you can F2 and learn how that formula is working. So F2 is one of the most used uh, shortcuts used in Excel. F4 is just to lock a key, a cell, and then there are the remaining mentioned in this presentation also. That's about it from my side. Let me uh, tell you how I'll just put up one Excel sheet for a short while and tell you how do I use shortcuts. So for example, let me put up an Excel and tell you how does a typical financial model looks like, and uh, how do you move around with different sheets in Excel. So for example, this is one of the models that I have. So here I can see that this is a dashboard. I can see valuation here, and I have to move within. So simple keys can help me move. And if I want to see that where is this number coming from, where is this parameters coming from, so I'll use control, I'll use curly brackets, I can reach that to that sheet. So I reach to this sheet from where this number is coming from. Now if I want to go back, I press F5 and this is what it shows me, and I press enter, so I go back to that sheet. So this is one of the most important keys whenever you are reviewing any kind of sheet, so you can move around in a model. F2 is a way to see where is this formula linked to. So these are most used formulas which I'm alt ohr, so I can just change sheet name using keyboard only. I can name it anything like model, for example. So these are typical shortcuts which are used, uh, or you can also, now this Excel, new Excel, since these shortcuts are coming in from old Excel as well, so the menu has been improving over the years. You can also hit and try as well. So if you press alt, it tells you which section do you want to go into. It highlights. If I press n, I can directly go to insert part. If I want to see charts, I just press r and it recommends me charts. So Excel has become a bit easier in terms of how to use from keyboard. It's telling you which keys do you use. So if I press h, or so it can tell me where do I go. If I want to change font, I press triple f and it shows me which uh, font I change. So this I all of this which I'm doing is being done through Excel only, through keyboard only, and which is one of the key learning part that you guys need to work on. Any of the questions that you guys have, you guys can put up on the chat, or anything you guys think that is confusing in Excel or financial modeling part which you guys need guidance on. Please feel free to ask questions. So first question is from Lake. I guess I have answered your question, Lake. If you can mention on the chat. Okay. So anyone else having any questions on the session that we just had? Any of the slides? I'll go over again as well. Any of the slides you guys think can help you? How do you show impact of qualitative factors? Okay, I'll repeat assumptions part. So first, let me tell you how to share a template for testing assumptions. So you don't test assumptions. Assumptions are your choice on how do you see the business, on based on the study that you've done about the business, or based on your economics. How do you analyze economics of that business? So accordingly, you assign an assumptions. For example, here this is let me put up one of the models back. So this is model of a chemical company. So this company generally makes a primary margin. So this is one of my assumptions on primary margins. So if I change these assumptions accordingly, my valuations will change. So here I have done a target price sensitivity. So in this you can see that what is the plant utilization. This is an volume assumption, and this is the margin assumption. So whatever is the assumption, accordingly your valuation changes. So I get 15.8 rupees per share of value when I have $90 margin and 93% utilization. So accordingly, and this selection of this 93 and 90 is my assumption of my base case. But in this sensitivity, you can tell whichever way those assumptions can move. Next question is how do you show impact of qualitative factors on Excel sheet? It's the assumptions factor only. For example, if Mizan Bank quality of service is better on maybe mobile application, if you think that mobile application of Mizan Bank is very nice and they can do well in the technology front, so you may give them an additional benefit of deposit growth. You may give them an additional benefit of non-funded income, which is internet banking charges are part of fees that the banks charge. So you can accordingly play that. So in any Excel sheet you will have you'll have those assumptions, and you can use that qualitative factor as a backing to your assumption. So any assumption has some qualitative aspect to it as well. So you need to quantify that in your assumptions, and accordingly build that into your model when you are doing valuation. Like, I hope I have answered it well. And this template part, I think it should be understandable to Mr. Who asked this question? Khurram. Templates are difficult for me to share because this is the learning part that you have to build a model from scratch. If we give out templates, it would not be a good idea for you guys to learn. You see, the learning part is this, that if you get more valuation model of any bank, that would not be fruitful for the business, for your learning, because you need to understand that financial modeling or valuation aspect is this, that you understand the business. You will have another session on how to analyze banks, how to what is the banking balance sheet like, how is what you can say, how should you analyze different aspects of the industry as well as a particular bank. So once you have that, you need to pull out that data and do that data mining yourself and build a model. You also have mentors who would be guiding you throughout the financial model building process, because having a sample would distort the learning part of understanding the business model. When you are presenting valuation to the judges in your finals and inshallah regional finals, so you need to have that aspect of how to, if you don't understand the business and you are just copy pasting another model and just putting up values on any other model, maybe I give you an HBL model and you just put in on HBL model you add Mizan Bank finances, that would not give the learning part that you have, that you guys need to learn when making a financial model. Okay, that's a very good question by Faisal. How can you forecast interest rates? Uh, so that guidance of macro assumptions you can get from your mentor, as well as there are different international agencies which give out forecast for interest rates of countries. You can also have research houses like Smile Iqbal Securities or Intermarket Securities or other brokerage houses. These are the just two coming out on top of my names, or BMA Capital for that matter. So they give out forecast of interest rates. They do have their forecast, so you may have access to those assumptions. Your mentors are people who are connected to industry, so they may also guide you further on how to from where do you get macroeconomic assumptions, which are obviously a main indicator for valuation of the business or a financial model. What do we do if we have an outlier exists in the data of last 10 years of financial statements? So you see, you need to analyze that data. It's not like you can simply just you can ignore that, because if there is any outlier in any year, you need to be aware of what an outlier can come over the next 2 years. So that may change your assumptions, that may alter your assumptions significantly. For example, if I have if I would be valuing any oil and gas company today, I would have this and if I would try to analyze past 10 years data, oil price in past 10 years has been in $110 range as well as $20 range. So I need to know, so if the year in which oil price collapsed or the year in which oil prices reached its peak, if I have 10 years data, I would have an idea of what that sudden oil price change impact was there in that year. So when I'm doing a financial modeling for an oil and gas company, my oil price assumption will be very critical. So I will be doing a sensitivity for $100 as well as $20. So that also gives you, that outlier gives you a clue on how to analyze or which factors are very much important for your for building a financial model. Okay, so data limitations are there. I think Zain has a very valid question that in past of the years, in past years, your financial statements, uh, financial reporting standards change every year. So there are different standards coming in, and companies are adapting to it. So you need to understand that what value driver is all about. So when I'm doing when I'm analyzing any company, and in previous session also, you guys must have learned that what is important. So when I'm analyzing operating costs, I need to see that what kind of reallocation or adjustments have been done. So I need to analyze, I need to backtrack my model accordingly whenever I'm analyzing operating expenses, for example, of any business. If the company was initially charging one of the operating expense in cost of sales, maybe I'm just guessing, so now they're charging it in operating costs, so I need to adjust my past data accordingly when I'm analyzing operating cost, and my future assumptions will be adjusted accordingly. Thank you. Then any other person has any question? Any other question? Can you guys see a blank screen? Excel. I would love to get a response in chat. Okay, you guys can see the model sheet. Okay, let me share again. Is it a blank screen now? Yes. So if I'm starting a new model, first thing first, I would do Alt O H R, and I would name it maybe assumption sheet. Then I would select this. I would squeeze one first row, first column, and I would start with this. Maybe I would say 2002, 2003, 2004. So I'm labeling years. In fact, let's keep it to 10 years. So I have selected this. Now I would say, for example, any company, I'm making an assumption sheet. So what is the volume? What is the price? And this is my revenue. So if I have an assumption of, let's say, 100, 120, then in a year there is a dip, then again 120, 130, 140, 150, 160, 170 maybe. Now I need to forecast for next year. So how do I see? I calculate volume growth. I will calculate accordingly. I hope you guys are following. So this is my volumetric growth over the past. So it has been slowing down. So now if it's a mature industry and volumes are slowing down, what I'll do is I'll calculate this and assume valuation. This is my calculation and this is my assumption. So if I assume that next year it will be 5%, for next 2 years it will be 5%, then it will reduce to 4%, and it will remain 4% until my terminal year. So that's the minimum growth that I'll achieve. For formatting, I often use Control Shift 1. It brings it to 2 decimals. Then I use Control H9 to reduce decimal. Control Alt H9, sorry, Alt H9. So this is how it is helping me. So Control Shift 1 takes everything to 2 decimals. Then H9, Alt H9, Alt H9. So this is how I can play with formatting as well as volumes. So now this is my forecast. How do I know that this is a calculation and this is an assumption? So how do I assign? There's simple rules of color formatting. You color this in blue, assumptions. You have this color code. Whenever I should open, or any good financial model should open It should mention what are the color schemes that the model will follow. For your input will be in blue, calculation is in black, and result is in green. That is, you mark this in blue, mark this in black, and mark this in green maybe. These are some of the ways that you can calculate. So for example, if I have now price, assuming the price remains same for next 5 years, so I assume a price growth. These are just indicators on how a financial model is built and how do you analyze. So it has been zero, so your future forecast will be zero. Right? Now here, sorry, the formulas have to be same. Formulas are in black and assumptions are in zero. So you calculate this by multiplying this. This is how you calculate your revenues. And now this is in, if this is the final result that I want to achieve, but here it's a calculation, but my valuation will be the green, will be in green maybe. So assuming that my net margin is also 10%. Alt HP is one of the shortcuts for percentage, formatting anything into percentage. So if I do Alt HP, it will be in percentage. So this is what, how my net profit will look like. I'm doing all this calculation in front of you guys so that you can uh, understand that it's not science, it's just about practicing how you have to calculate, how have to, you have to build a model. So I just built a revenue profitability basic assumption set, and how do I look, how does the assumptions look. So if I make this, let's say if I assume that 5% will be the net margin from here, my assumptions will change. And assuming that this is the cash flows, if I am calculating NPV with the, let's say, discount rate of 15%, if I have to calculate NPV, this is the interest rate that I use, this is my 5-year cash flows including the terminal year, maybe in fact I should be cash flow stream. So forecasted cash flow stream, assuming that profit is the cash flow, and here I am also using terminal year exit multiple of 10. So now when I do valuation, I use NPV, 15% discount rate, and this is the cash flow stream from here onwards. If I'm doing a December 20 valuation, what cash flows that matter to me are cash flows after December 21. And after 5 years, there's an exit terminal that I've assumed here. In your valuation methodologies, you can have different ways to calculate terminal value also. You need to keep a watch or just follow what your mentors guide you through. This is just a way to analyze how Excel based models are built. So this is the valuation of the business that we've arrived at. Since this is an output that you are getting at, this is how you highlight it. Cash flows calculations should be in black, linkages should be in black, and assumptions should be in blue. This is just a basic color coding, basic valuation method. This sheet I'll surely send you guys a model snapshot. This will get it emailed to you so that you can understand how a basic financial model structure is all about. Hope this was clear and easier way to understand how a financial model is built. Okay, so I have a question from Muhammad Miraj. Miraj, you see, it's so for 9 months, you cannot you don't assume complete CY20. You analyze those quarterly results separately, and you forecast one quarter, and accordingly, you also reach at how you also forecast how that how full year will look like based on 9 months result and one quarter which you are forecasting. Accordingly, you will have this 2020 number that I have assumed here. You will have 2020 number will be estimated and remaining numbers will be forecasted. This is the difference, that you have an estimated year and then you have forecasted year. This is estimated because 9 months results are already out. Any other question? I'm waiting in the chat box. You guys are free to. I think that's a valid question from Tahir. He's one of our renowned mentors and investment professionals, NCFA member also. He's saying that whether you guys, it's up to you guys, and it's a valid point. I think it's up to the analyst that whether you want to build a quarterly model or annual model for the valuation. But your workings can be in quarterly. But I think for presentability, for charts and for reports, it's good to have annual snapshots in the model, so that when you are presenting to the judges or you are including that in your forecast, judges can understand annual story better, because it's good to summarize how over 5 years how cash flows or profitability will look like, rather than having a quarterly forecast, and it's difficult to present. Otherwise, calculations are completely up to you guys, how you are comfortable. If you're comfortable building a completely quarterly model for a bank, it's completely up to you. But you can use some if and different formulas available. Your mentors can guide you further, which can give you annual snapshots, and your calculations will be in quarterly mostly. So that's not a that's completely a discretion of the analyst. Any other questions? Feel free to ask. This is your 10 minutes chance. I think there is no more question. There are no more questions, I guess. How can we factor in uncertainty like COVID in model? Sensitivity is the way to go for. For example, if you are making a valuation model that has some assumptions, you can come out and tell through your sensitivities that this is the risk that is there. So the risk is separate. So you need to cover that in your report. You would give an investment thesis based on certain assumptions only, and then you can give a sensitivity or scenario analysis that if COVID like factor happens again, this is how uh, this is how your model will this is how your company's valuations will change. Tahir, we are planning another session, most likely on report writing as well. Uh, Hopefully next week, only early next week, we'll have one session on banking, and we'll have another on report writing also, how investment writing is all about. No, I think technical analysis is not to be covered. It's purely fundamental analysis, which is part of this complete assessment. So you analyze on based on fundamentals of the business only, how to value a business, and based on that only you assess, because technicals is generally used, generally not particularly, but generally used to for trading. But here you are doing valuation, which is an investment analyst job, which is generally fundamental only. Now, since there are no more questions, I would request all the participants oh, sorry, we have one more questions. What are most built-in formulas in a model? Completely on you guys, Hunain. It's completely on you guys. How do you want to analyze the business? How do you want to build those assumptions into, just like I showed you how revenue and price, how price and quantity can be multiplied to reach out revenue. You can build your own model. You can build on based on different assumptions on how this calculation can be achieved. It can be a 20 row assumption also to reach at a price. So your price might also be influenced by multiple factors. You may want to put that in also as an assumption. So it's completely on you guys how you want to structure your model formulas. So it's generally recommended to use consolidated financials, but I think it's no harm in using unconsolidated model as well, unconsolidated financials as well. You guys can one thing which is generally recommended, or I would recommend at least, is if you are doing unconsolidated valuation and there is a subsidiary of or any associate investment that the company has which is not giving out dividends, so you can calculate, you can value that business separately and add that directly to your valuation. So you can't ignore any aspect of the valuation, because you're assessing complete company, all the investments that even that company has. You need to value that. If that company is dividend paying, you can just discount those dividends and get a separate valuation. Or if you are forecasting in your unconsolidated statement only how dividend is coming in the future years, I think then it will be covered. So it's also subjective on how do you want to capture it. You need to capture all of it. Okay, so now I think since there are no more questions, as at least so far I can see, I would request everyone to open your videos for a photograph, for a group photograph. Mizan Bank as an investment, ask your mentor. Okay, so we need to have more people to open up their videos.
Satish, you'll have to stop sharing your screen.
Sorry,
You will have to stop sharing your screen.
I'll have to stop
Yeah.
sharing. Okay, sorry, my bad. Okay, so I will request again, everyone who is there in the session, please open your videos for a group photograph. I think we have some people in the waiting room. Maybe we can invite them for picture. Okay.
Satish, I think we're done.
Sorry,
I think we're done.
I can't hear you. You can type in the chat. Okay, the picture is done. Okay, so that brings us to the end of the session. Thank you, everyone, for joining in. If you guys have any further questions, you can write in chat box. And good luck for your exam. Thank you.